Michael says, hey guys, I'm so happy I found your podcast. I've gained more financial knowledge in just 2 months listening to it than the previous 47 years of my life. That is quite the statement. Thank you. Wow, Michael. So Michael says his wife is 52. He's 47, and they make $230,000 a year combined. He has $50,000 in his high-yield savings account. 401ks are maxed out every year, and they currently have $750,000 in them. He's got a maxed out IRA at $14,000. He's buying a little bit of VOO and SPYI to get started in his bridge account. He's got $90,000 of non-traded company stock that's averaged 22% annually over the last 16 years. That's pretty cool. Let us know the stock so we can buy it too. He has a house that's worth $425,000 that he owes about $215,000 on. He has a 3% interest rate. He's only 5 years in on a 30-year mortgage and has no other debt. And finally, he has 2 decent low mileage cars, which are unfortunately driveway ornaments because they have company cars. Michael says, I'd like my wife to retire in 10 years at 62. I want to retire in 10 years as well. My question is, with this extra $2,000 to $4,000 a month that we have, should I be dollar cost averaging into my bridge account and buying more shares of VOO, SPYI, and maybe even some single stocks, or throw every penny at the mortgage principal, or maybe a mix of both? The low 3% mortgage rate is what raises questions about the need to attack that as aggressively as possible, but I wanted to ask you guys first. Good question, Mike B. I will let Robert take this one.
Yeah, I mean, you already know the answer here, Mike B., and that is I would not touch the mortgage. You are blessed with being able to borrow money for under 3%. And even in down markets over a long period of time, the S&P 500 averages, 9-10% a year. So you're going to be in a much better position there. And something I say a lot, Mike, if you haven't heard it before, is that wealthy people always make sure that the positive arbitrage of the money that they're working with is in their favor. So what does that mean? It means if you can borrow for 3% and make 10% with your money, you're always going to borrow. That is why the wealthiest people out there, they have mortgages, they have loans on their boats, loans on their office building, loans on their cars, because they know they can borrow it cheaper than what they can do with their own money. So in my instance, absolutely dollar cost average, leave the mortgage alone, keep doing what you're doing, you're crushing it, and then you set yourself up so much better in retirement because you have all of your money working harder for you, and you ride that low interest mortgage as long as you can.
I totally agree. So he's saying they're maxing out their 401ks, maxing out the IRAs, and what to do with this $2,000 to $4,000 extra a month. I would start really building that bridge account. You said you've got 90,000 of non-traded company stock. I'm assuming you like the stock. It seems like it's performed well, so I'd hold on to that, let that continue to grow for you. So go to public.com, open up a normal taxable brokerage account, which we dub the bridge account, and start buying more shares of VOO, VTI, SPYI, MOAT, VGT, QQQ, all the big index funds and ETFs that we talk about. Don't worry about the price action that's happened year to date. We're going to be looking at 5, 10, 15, 20 years ahead of us. And over that period of time, you're going to be up big on this account. So if you're building this account from absolute zero right now, like you just open the account on Publix brokerage and you're ready to start investing about $2,500 a month at a average 8.5% annual return, you're going to have $500,000 in this account by the time you retire at 62. That's pretty cool. That's another $500,000 that you're going to have. And then that $750,000 that you guys have in your 401ks, that's going to be worth probably $2 or $3 million because you're continually maxing that out. You're going to have that principal grow over time as well. I mean, you guys are going to be set up for success when it comes to a really healthy retirement. So congratulations, Mike. Congratulations to you and your wife. You guys are going to be doing just fine.